Introduce yourself. Okay,
All
we're
right.
live.
All right, live. So this is like live. Tim Arrowood here with People's Home Equity. I'm a branch manager and mortgage loan originator, licensed in Tennessee and Virginia. So this is my favorite place in the whole world because all my favorite people kind of ended up at one spot. So it's it's a joy. I finally, like about 2 weeks ago, I started to actually get out. You know, I've been a little pasty, been in my cave for like 3 or 4 months. You know, part of it was COVID, and part of it was just trying to keep my head above water. So we've hired 2 people in the last month. So you know, like just September was a huge month. We pulled off a lot of loans, hired 2 people. We had our drive-in movie show and stuff like that. So it was good. So I'm just glad to be out. And, so thank you all for letting us come in. And I spent some time. I was asked a few people, and the only person that always has questions is Matt. So Matt gave me a long list of questions, which is good because I'm like, I have to go this way, I have to go that way. And so he just rattled off a bunch of things, and so I took the time to do a little research and remind myself of some things. So, you know, this is just, I'm looking forward to getting some feedback from you guys. At the end, what I want to do is I want to find out what you think is going to happen in 2021. I want you guys to put your prognosticator hats on, because we're in the middle of doing.
We're in the middle of Revelation right now.
I'll sketch tomorrow.
Yes. So, you know, strategically, you know, I'm spending all of November doing strategic planning. So we're doing mission and vision. We're doing something called a SWOT analysis. I don't know if you guys ever done that. Strengths, weaknesses, opportunities, and threats. And
say SWOT analysis?
SWOT. Yes, I wouldn't, yeah, I know better than that. It can kind of swing at you. Even though I do have a lot of protective layers, you know, it wouldn't be great. I fall hard. So the big questions that Matt had, you know, he was like, who are underwriters and what do they do? Right? So who are these mean people that say no? Yes. So the way I describe it to borrowers and different people like is underwriters are like the judge and the jury. And we, the loan originators, are the attorneys that are pleading the case of the borrowers. So we understand the laws or the guidelines for underwriting, or we think we do, right? We're not supposed to be as smart as the underwriters. The underwriters are like gods. They, you know, 3 Gs, and they're typically they typically work from home. They have, I think they drink and they smoke a lot because all of their voices are raspy. They've been in business a while.
Not an underwriter.
Yeah. So their job really is to know and understand the guidelines for the products that they have very, very well. And then when we come to them with our file, they say, this is what the guideline says, and this is what the loan officer has put in front of us. And they're, yep, that works, no, I don't understand that, you need to clarify that. And then they're very detail oriented. So you know, they love guidelines, they love details, and the company relies on them to keep them out of trouble. So if they do a loan, let's say they do an FHA loan, and that it doesn't quite meet the guidelines, when it is, you know, the way the market works is we, meaning the company, is going to, well, all the loans that we do would have the ability to be sold on the secondary market. I don't know, does that make sense to anybody to say? So they're bundled, they can be bundled, they can, so if they meet certain criteria, they can be like any other.
Is it more marketable?
It's marketable, and so, you know, if you've had a loan before, you could say that, you know, well, you know, so-and-so, they serviced my loan, and then they sold my loan to somebody else, and they sold my loan to somebody else. So the reason that it can be sold is because it meets certain minimum requirements, and it is, you know, there's trust that it's been done correctly. You know, the terms can never change for the borrower, anything like that, but, you know, so it is a component, it is, you know, it's been underwritten to certain guidelines. So the job of the underwriter is to make sure that's true. So if they make a mistake, their job is on the line. And so what could happen is it could be when it goes through an auditing process, later on down the line, they could say, oh, this wasn't done right, you left this piece of paper out. Then they're like, we won't buy that loan, and so now it's not sellable on the secondary market, so it has to be fixed, or it has to be, it's one of those like damaged goods that's over the corner, right? It's collecting dust, somebody's gotta pay for it. So their job is, one of the most important jobs. I think the loan originator's job is the most important. But their job is to make sure that that it meets that criteria. So, typically they've got 10 or 15 years of experience. And so their part in their role in the process is we're gonna go to them and say, the guideline says this. And the hard thing is you're gonna have different guidelines for different things. So there may be somebody that's really good at conventional loans, somebody that's good at VA loans, and that may be all that they do, because they're, all loans are similar. We just wanna make sure you can pay it back. But the details is where it gets harder. Well, VA says this, and USDA says this, and FHA says that. Like one of your questions about flipping, like I'll talk about that in a minute. Like somebody buys a house and they're gonna buy it, flip it, and they sell it within 90 days, and it increases the value of it. Well, FHA cares more than the other loans, so you gotta know what's going on, because you can get in trouble. Oh, I missed that part. There's just a lot of detail. So that's what the underwriter's responsible for. So they're the judge and the jury, and so we can appeal. And because there is, some things are black and white, but some things are interpretation. And I had a file not too long ago that there was an interpretation, and I didn't like that interpretation. So I took it to her boss, and she still liked the interpretation. This judge, I took it to the state Supreme Court, and then I took it, finally, I couldn't take it any higher. So I took it to who actually ends up being the wife of the president, but she's also the head of credit. And she agreed with me, which is kind of cool. And so, but it took a lot of effort to get there, because, it was, selfishly, I don't get paid until it closes, but, I've made a promise to the borrower, and, this is not reasonable. This is not reasonable. So we have ways of escalating that, but I couldn't go any higher than her. So occasionally we get something called a golden ticket, which says, I know this is really not supposed to work, but can you make it work? And so those are rare, but usually use those for family. So does that make sense? I mean, does that kind of help? It's probably pretty basic stuff, but the other question you had was, what is CTC? We have a bell in our office. Here in our office, we have like a dinner bell, what we call a captain's bell. So whenever we get clear to close, we ring the bell. So either the fish is really good, or we're clear to close. So that's a celebration for us. CTC is clear to close, so that means that we've done all the work. The underwriter says, I'm done with this. So now it's just a matter of drawing the paperwork, drawing the documents, getting the wire ready, and all those kind of things. And so now things can happen after it's clear to close. Something could happen. We find out that the borrower loses their job, or there are things that can come up, but it's rare. So usually it's when the borrower does something stupid, or they lose their job or something, or they go buy a car when they're not supposed to. Because there'll be a soft pull down on the credit just before closing, and we also will do a verification of employment the day of. So we've had people through the years that I'm out. So the day of, they quit their job. I've heard of that before, and it's like, well, we do a verification. Well, they just turned in their resignation today. You get a house when you do that. So that's clear to close. And let me think here. You were asking about the average time to close in the current environment. That's a really good question. So what are you guys hearing from other lenders? With how long does it take to get closed? Is it pretty much?
It depends. If it's USDA, it's got one that's like 48, 49 days by the time we get closed.
How about you all? You're seeing?
We haven't had any delays yet, thank goodness.
Yeah.
I typically write them for like 45 days out and hope to close
just out of caution, write them
Yeah.
extra long and then.
Same here.
We do have one for 90 days right now.
Yeah. Yeah.
I got one for next year.
Look at that, look at that. So,
And it's land?
it's like, don't have to worry about home inspection?
Nah.
It is.
Environmental inspections though.
It's in January though, right?
Yeah.
Yeah.
So there's several different things that are going on. So the things that we can control, or we think we can control, is our side of things, underwriting. The things that are outside of our control that we've really been frustrated with lately, it's hit or miss. It's title and appraisal. So I'm, I've had, it's just a mixed bag. In the last month, I've had an appraisal come back in 4 days. Like, it must have been their neighbor. The appraiser's neighbor. That's the only thing I can figure, because it's like, why? Or I was going to that neighborhood anyway, I picked it up, I took care of that while I was out there. And I've had some that is, it's 4 weeks just to get the appraisal back. And so the way the appraisal process works for us is that we have a pool of appraisers. We're not allowed to, we gotta put our hands over it and stick our hand in the jar and pull somebody. And so, because we don't want to have collusion with us and say, hey, I've got, there was a guy, we used to, I call him Refi Ralph, because he always came in over the value that you really wanted. So it was like, if I could only get him for refinances, this would be awesome. But we can't pick one, which is appropriate. But what happens is there's a certain pool of appraisers. We can put them in, and so our appraisal management company is supposed to use them as the primary. So they'll send out, we get an order, and they'll send it out to all of them and say, who picks it, who wants it? It's like, I'll take it, I'll take it, I'll take it. If they don't respond in a certain amount of time, then it goes to another circle. And if they don't respond in a certain amount of time, it goes to another circle. And so I had somebody just the other day that came back. It was a simple place in Elizabethton. They came back with a, I can't remember, there's so many going through my head right now, maybe one of yours. But they wanted $1,600 for an appraisal on a 2,500 square foot house. Now, they thought that there was 20 acres with it, but there was only an acre and a half. So they're like, no, we're not paying that. We're not paying that. And he said, well, I'll take it, I need 6 weeks to do it, or if you want me to do it before I go on vacation, then I'll charge you $1,500. So that's the kind of thing we see on our side, right? So it's like, no, we're not gonna do that. We can't, so, we make a promise to the borrower that it's gonna be $475, $500, $525, whatever it would be. There are some circumstances that can change, but usually if it's significantly over and there's no reason, there's no documentable reason that, okay, we thought it was a 2,000 square foot house, but it's actually a 20,000 square foot house. Okay, so there's different comps for that, different kind of workload. But if there's if we can't justify the difference in pricing, we have to eat it. So, and to this person, I said, look, I don't know, it shouldn't cost $1,500, but what I'm gonna do for you is that I'm gonna work on trying to find somebody else to do it, but if we can't, how about I'll take 500 of that, and then you take 1,000 of it, which still I feel dirty, doing that, but it's not like I'm marking up the invoice. But those are the things that we run into, and so it's just hit or miss. You're dealing with people's vacations, holidays, they just, they're like, I've got enough business, I really don't wanna do it, but I'll take it if you pay me this much for it. And so it makes it difficult. So that's really, we run into challenges sometimes when it comes to, do we order the appraisal now? Because it's like, we wanna get it in the queue, because it could be a critical path. And then we're running into title things. It's just taking a long time to get title back. And, it just depends. People get loaded up, just like we do. And so those are the external things. Now, for us internally, we're running, up until 8 months ago, we were having 24 to 48 hour turn times on underwriting. Like, so submit to underwriting, it's like clockwork. Now we're at anywhere between 7 and 10 working days to get something back from underwriting. So what we've always done through the years is we want to have a really, really good file to send to underwriting. So we want to be the guys that the underwriters say, oh, I love their files. We want, they're thorough, they know, so they go in, they come out, we know they're clean. So for us, there's less risk, which kind of goes into, well, if we pre-qualified somebody, we did our job, then it should be a clean file. Sometimes, I know some loan officers just like, see if it'll stick. Oh, that one didn't stick, it'll be all right. Does that stick, and I just can't work that way. So what's happening now is we wanted to have everything together so that we could send it to underwriting and then go, they're closed, or be very, very clean. Now, we're just getting in, and then we're continuing to work the file for another week and a half to make sure, to fill in those holes, right, backfill in that, which is not the way we like to work, but we gotta get them in, And, so we do have the ability, to manage our own pipeline within there, but, you know, the ones that are difficult are the ones that we know that are marginal, and we're waiting on an answer from underwriting to be able to see, you know, did we do this right? You know, sometimes you just don't know. You know, there's the ones that are, this is a slam dunk yes, this is a slam dunk no, and then there's the ones like, it's gonna come down to the interpretation to the underwriter. And are they gonna accept this, you know? Then, you know, those are the ones that you're already 2 weeks in. You know, usually you would have gotten that answer back quickly. You know, 24 hours, 48 hours, no harm, no foul, I'm sorry guys, we thought we'd try this, you know, we haven't spent any money on appraisals, haven't spent any money on home inspections, you know, we haven't really hurt the seller that bad. You know, those are all things that luxuries that we just don't have anymore. And I heard somebody say, I don't know, sometime this summer, that the entire mortgage industry is trying to push $3 trillion worth of mortgages through a $2 trillion pipe. So, you know, we have, corporate has, I hired 2 people last month, and I was frustrated because HR couldn't get me the documents to get them onboarded. And I found out that, after complaining a little bit, they said, you know, they were kind, they said, I apologize, but, you know, we are onboarding 150 people on Monday. I'm like, oh my goodness, I'm so sorry, I'm so sorry. And they said, we've onboarded 350 people in the last 4 weeks. And that's across, you know, that's branches around the country, that's corporate. And I can't imagine how many laptops they bought, because, we're just, 2 people, it's like a whole office in a box comes with them. And to onboard 115 people on one day, and they all have to have equipment, and headsets, and laptops, and 2 monitors, and so a little change too. So what we're seeing is I'm asking for 30 to 40 days. Right? Now, if it's USDA, because there's another layer of underwriting. So usually, you know, USDA, the file has to go from us to, used to go to national, I don't know where it goes anymore, but it has to go, we have to deliver the file to the USDA for them to do a review of their own. So it's usually a rubber stamp, but that rubber stamp could take 2 days, it could take 2 weeks. So that's the reason we ask for more time, hoping that we're gonna get our stuff done as quick as we can and get it to them. So, does that answer kind of give you some insight of what we've been going through? So
I think a lot of people too, because they'll hear like Misty or Joel, and they think an underwriter is just another like Joel in the equation.
Right,
An appraiser is like a Misty. So when they're like,
Yeah.
why is this taking so long? I don't understand. Like they told me, and it's like, look, this is outside of that
Right.
realm. This
Right.
is, they have to play ball with these people who are doing stuff like, 2,000 and I'll make it happen, man, twist his mustache type thing,
Yeah.
It's not like, we can all get an agreement here and have this done by this time, I'll just go knock on the door and ask to be done. There's
Right.
different gears to the machine of
That's right.
lending, and so.
Yeah, and those people, I mean, the underwriters are not on our premises. Everything else that we do, well, the closer is not, but we work with the same ones all the time. The closers are the people that are kind of putting all the final paperwork together, and you all wouldn't probably deal with them. The title companies would, they would know them well. So they would be able to talk back and forth, and they're balancing the CD and all those different things at the end. And then you get the wire transfer. Yeah, there's a lot of moving parts to a mortgage. So we try to make it look easy, but it can be it's I don't know why we got into this business. Actually, I never dreamed. I mean, many of you already know my story, but I didn't grow up in the mortgage business. Went into banking 10 years ago, almost 10 years, and it'll be 10 years in February that I started out. Didn't know anything, but hadn't done the very first mortgage. Took the class, passed the class. Didn't have my. This is recorded, so I won't tell the whole story. But there's a fellow at church, a friend of mine, and I heard him say in the vestibule, he said he was gonna buy a house. And I said, I'm doing your loan. He's like, okay. I said, I've got to do your loan because I had just come through I actually just come through a bankruptcy and foreclosure and lost everything after a business failure. And so it was so that year was kind of exciting. So I learned a lot. So, so we talked about title. I did a little video the other day on property inspection waivers. Did any of you see it? So what is a property inspection waiver, since we're talking about appraisals? So there are times when we can get a waiver that says we don't have to even order an appraisal. Right? We don't even have to make sure that the house is still standing. So that's called a property inspection waiver. So usually we get those when we have a really well-qualified borrower, high credit scores, low debt to income ratios, putting money down. Say they're putting 20% down, buying a house that has been on the market, has been around for a little while. Like a new construction, we wouldn't be able to do that. But the agencies, the Fannie, Freddie, those guys have actually loosened their requirements because all of this business that's going on, there weren't enough appraisers to do the work. So what we do is a part of our process is taking the data on a particular individual and their financial data, put everything together. We run it through an algorithm called an automated underwriting system. So I don't know, I think it's mentioned in real estate school, but AUS, we call it DU or LPE, those kind of things. And so it's like, it's like pulling the lever, and are you gonna win? Because it's like, oh, I got somebody that's a good candidate. And it's like, yes, I got the property inspection waiver. So I don't have to worry about spending money on it, don't have to have the time, waiting on it to come back. It's just one piece of the puzzle, and it just basically says, based on our database and what it thinks about the property that you're buying, or even a refinance. I did my own refinance, and I got a property inspection waiver. So, and it was worth, the property inspection waiver said it was worth more than I thought it was worth. So I don't really know how they come up with this, but those are awesome. People moving in from out of town, they're putting 20% down, whatever would happen to be done. But it is something that you don't have to have an appraisal at all. Don't have to do a drive-by to see if it's even standing. So.
What if they're paying cash for everything? Would it be
We
waived
don't
in
like
that?
those people. That's called 100% down, and they don't need a loan officer. So,
What if they're paying a significant part of the?
when they're putting a lot, that's one of the factors that allows us to get a property inspection waiver. Is they're putting, usually it's 20% or more down, and that's the reason that
It would be waived.
Yeah, it would be waived.
Okay.
Yeah, in a situation like that. So, have you all experienced any of your files that they've at least been told that you got a property inspection waiver?
Had one.
Yeah, I think I've had one.
Yeah.
I had one that thought that.
Oops.
Yeah.
Yeah.
He and I didn't really see eye to eye on that one. What's to say?
Okay. I'll find out about that one later. Another question that Matt had was about property flip rules. So like somebody buys a house, they're going, there's a lot of it going on right now, but if you buy a house, bought it for 20, I'm gonna put 50 in it, and I'm gonna sell it for 150, we're gonna flip the house. So conventional VA and USDA, they don't care. It's like you could have bought it for 20 or 50, on Friday, you painted it over the weekend, and you're selling it for 100 on Monday. Right? So probably not gonna happen, but they just care that the appraisal comes back and says it's worth that much. So there's no particular rules with that. Now FHA is a little bit more picky. They after 2008 they put in a lot of different rules. But so what FHA really cares. So if it's going to be a flip within the first 90 days, we cannot close on a loan in the first 90 days. So if somebody buys a house or a flipper buys it and they close on it today, then in 90 days we cannot close on that with an FHA loan. Could with a conventional or USDA or VA or any of those. But FHA we can. So
90 days from the time they have closed on it?
That's correct. So you bought it today, then that's going to be the records are going to say that you closed on it on Tuesday the 4th? Third. Yeah. So we're going to go back and we have to prove that, and then we're also going to prove how much you paid for it. So that's another trigger. So the first thing is, you cannot close in the first 90 days. Now, we have some clarification that we can get started with the borrower. Let's say you're a month and a half in, I fell in love with the house I'm gonna get, it's maybe not even done yet. But even if it is done, we can start the process, get a contract, order the appraisal, do all those different things. But what happens is on day 91, we have to cancel the first contract, create a completely new contract with a new closing date, but we can use the old appraisal. So it's like,
You have to add a second appraisal after that?
well, it depends. So if the value has increased more than 100%, so if you bought it for 50 and you're selling it for 120, okay, it's increased more than 100%, then more than likely we're gonna require a second appraisal. So we got appraiser number 2 checking on appraiser number 1 and making sure that the value is really there. Because it's like, well, that's a big deal because the value has increased so much. We wanna make extra sure. So,
Now, closing costs would be a little bit beefy for the buyer at that point.
pardon?
Now, closing costs would be a little bit beefy.
Well, the thing about it is that we're not allowed to charge the buyer for that second appraisal. So I've got to eat that, okay? Or figure out a creative way to get somebody else to pay. So, so that is, I mean, we've done it different ways through the years. I used to see a lot more of them than I do now. But, you know, the folks that I have worked with that are doing the flips, they're buying them and it's just taking them a while to get them done. So by the time it comes around, we don't have those issues, but it still happens. But it really depends on how much it has increased in value. So yeah, I've got one right now that's actually, we just got the second appraisal in. And I believe we used the first appraisal as the value. I have to look that one up. But it's, you know, and what happens sometimes is, you know, many times those are lower priced homes and the cost for the appraisal, and it just adds cost, and we're like you guys, we're lower priced places aren't as profitable as higher priced places for us, but that's part of the business. We just, if it needs to be done, we'll eat it or figure out some way, but the borrower can't buy it. Can't pay for it.
Different, like, what causes on the lender side for closing costs to vary?
That's a really good question. So I'm surprised you didn't ask that one. He's the closing cost king right there. So when you look at closing costs, I usually lump closing costs, a lot of things into closing costs, because the borrower really cares about what's the total out of pocket that they're gonna have to spend. The 3 main areas are the true closing cost, which is title, appraisal, any of our fees, all that stuff. That's consistent across the board. The challenge comes with the points that somebody's gonna pay for a particular rate. So, you know, right now it's running about, I mean, on average, people are spending 1 point. 1 point would be 1% of the loan amount is what they're gonna, to use to buy a particular rate. That's a whole other conversation that I'm glad to go into it, but, and I spent a lot of time going through it, but when somebody has a low credit score, there's not a lot of appetite on the market for people for remember I talked about the mortgage-backed securities and how these things are all, the market is established whether they want that particular file. So if it's a low credit score, typically anything under 640, we can go down to 580 on a credit score. But if you got a 580 credit score, the good news is we can do with them. The bad news is it can be really expensive. And what I mean by that is that the closing cost, title work is all the same price, the appraisal is the same price, our fees are the same price. But the cost for that rate can be quite a bit more. So depending on, and it's all, everything we do is risk-based. So there's a perceived risk in the market for somebody with a low credit score. Perceived risk for somebody that want to buy a manufactured home, right or wrong, that's just, so there are adjustments that are made to the rate for different things. So, you know, somebody with an 800 credit score might pay half a point or a point to get a particular rate. And if you were to look at, it's kind of weird, when we talk about, it's taken me a long time to get my mind around, I'm selling money, right? And so how can money cost different amounts? It's just like $1's a dollar, you know? Well, it's when we look at the rates for the day, we'll see, okay, we've got rates from 2.5 all the way down to 5 on this side. And then over here, we'll have the cost for that particular rate. So in general, the higher the rate, the lower the cost. It's kind of like a teeter-totter. So if I push your cost down, then your rate's gonna go up. That's generally what has happened through the years. And you said, oh, you want a lower rate? No problem, I'll push your rate down, the cost goes up. What happens is when you've got those external forces like low credit scores, then there's really no bad rates, there's no good rates, but they're all expensive rates. So if this was a rate sheet, it would be like, I've got rates from 2.5 to 5, but they all cost 3 points. Like, because nobody really wants that deal. And so the good news is I can get you somebody that's got a 580 credit score, I can get you a 3 1/8 rate. That's great. Well, I don't wanna spend that much money on that rate. Well, let's take you to a 5. Well, that's 3 points as well. So why would you pick a higher rate at that point? So we're stuck because we don't have any other options. So you've got, and then it's compounded by the fact that many times, not always, but many times you got lower credit scores, you got a lower purchase price, you got high cost for that particular rate, and so the percentage of the closing costs just get crazy out of whack.
So, the way I'm picturing on this scale, so say if a rate's, you wanna get a rate at 3.5%, but, you gotta buy it for, the point is what is going to vary based off person by credit?
Yes, correct.
Yeah, okay.
Correct, yeah. So there are a lot of different factors that go into credit, into what rate somebody gets. Primary. Yeah, the big one. Can't say that word, so I won't use it. So it is really credit score. Then it's debt to income ratio, it's loan to value, and as you might imagine, if you're putting 50% down, then you're a lot less of a risk to us because, first of all, you've got skin in the game, right? You're probably not gonna walk away from that deal because, you're gonna fight for that because I put $100,000 down. If you're putting nothing down, then that's a fair amount of risk for us because, hard times come, you just walk away. Right? It is your primary residence, and so you're gonna fight for it some, but you're gonna reach a point where, but if you've got 50% down, it's like, I'll figure out a way, I'll sell it first before I'll have to go back, because I don't wanna let that equity just go. Right? So those are all the risk factors that go into it, and I don't pretend to know all of them, but it's all cooked into the rates and things like that. And like a condominium can be a little bit more expensive than a single family residence. A PUD's okay, it's just basically the same as a single family residence. But those are all the factors. I was doing investment property with somebody, I ran some numbers from the other day, and it was at 20% down, the rates were high and expensive, and we went to 25% down. It was like, oh my goodness, this is like buying a single family residence. They were in the high 2s, low 3s, and not a lot of points, but it was going from 20% down to 25% down. So, I know the fundamentals, but it's like it's changing on me, it's changing on us. I'm thinking about like self-employed borrowers. It's been a tough year for self-employed in general, but self-employed borrowers, it's like, we always have a magnifying glass for people, but when you're in self-employed, it's like we're gonna crank up the electron microscope and look at everything on you, because it's so, profit and loss year to date, we're looking at, it's difficult. So, does that answer your question about the rates of credit? So the big three are points, closing costs, and then prepaid items. Right, that's the way I break it down. So the big one that really fluctuates is going to be the closing costs, or the points. That's the part that I see most of all.
I have 2 quick questions.
Yes.
Number 1, can you touch on what you do for Homes for Heroes?
Okay.
And then the second question is, can you touch on how FHA inspections, like required inspections for home differs than other lines?
Okay. Homes for Heroes, we're a proud member of Homes for Heroes, and what we typically do is provide a free appraisal to the veteran or the hero. So what we'll do is, like a VA appraisal is typically $560. So we'll leave it on, and then just before closing, we'll provide them with a lender credit to wipe that out. And so that's that, and I think we treat everybody really well. But I think that a lot of the veteran stuff that we do is I was thinking about Alexa. Remember what's his name? Well, you don't need to have a name. But there's a fellow that we worked with that had he was homeless.
Yep.
And he was living at the VA.
Yep.
And that was I often thought of him.
That was a special one.
Yeah,
Yeah.
and so we helped him with his credit score. You know, he's actually homeless, living at the VA, and we, you know, he has settlement and some things from disability, and he's in a nice house on the lake.
Happy
So-
as can be.
Yeah, yeah, and but that's, so that's what we do for Homester Heroes. And the other question, because I have such a short attention span, I can't remember that.
That's kind of the
FHA.
same question, yeah, like, so if we're trying to buy a mobile home or something
Mhm.
like that, is there something additional to like the appraisal or something that'll be needed?
So Mackenzie and I, we talked about this the other day, so when we're looking at the continuum of hardest appraisals, or the most, let's say the most thorough appraisals, to the least thorough appraisal, we're looking at the VA is the most, and then it's FHA, USDA, those are right in together, and then conventional. So, you know, there are, you know, with conventional, you can get by with, you may not have to turn the water on, you may not have to do some of these things, it can be a little rough. Now, I think all of them, well, especially FHA is gonna, if you've got peeling paint, anything like that, they just want, you know, they're a government-backed program that wants, whether it's a VA loan or an FHA or USDA, they want, it's intended to help a borrower buy a house, typically, maybe not necessarily a first-time buyer, but, you know, somebody just getting started. And they wanna make sure that when they move in, that the place is safe, sound, and sanitary. There's no accounting for taste, right? It could be 60s paneling and shag carpet, as long as it's not, as long as it's safe and sound and sanitary, right? There's no, it could be Pepto-Bismol walls, you know, or, you know, there's pretty, toilet colors and, all that.
Turquoise.
Turquoise.
Turquoise tub, toilet, and matching.
Yes, that was a kit,
Nice.
they bought that, we saw a lot of those. But those are the big things, and I should probably do a whole thing just on, actually, probably I'll try to get an appraiser in, that'd be good.
Yep.
They're so busy right now, cost me a fortune to get an appraiser.
You're like,
$1,500, get an appraiser in here, maybe with some burn-ins when we get them in. I'll work on that, I'll see if I can get somebody, everybody's just so busy, but I think that'd be good to quiz them on that stuff.
it's pretty case by case too. I've had FHA shut me down because they tried to turn on water and there was sediment in the little screen, and they were like, "Oh, we gotta fix this." And like they came in there and were like,
Yeah,
"No,
Yeah.
pass." That's all they did.
yeah, it's
Yeah.
it's subjective, yeah. You did have a question about the,
I think mobile homes and
mobile homes. So, you know, we do manufactured homes, we do FHA, USDA, THDA, conventional, VA, and mobile homes. Now, USDA, it has to be younger than 2006. If the double wides was manufactured in 2006 or later, in the state of Tennessee, we can do them. Virginia is different, and it's actually an exception with USDA. So that's the reason this is, you know, it's so difficult sometimes to say, well, you know, yes, you can do it double wide, but you're trying to explain it to a borrower. And even me keeping it up is difficult, but, you know, so, you know, you pre-qualify somebody for something, and then they didn't mention that they were interested in manufactured homes, and then it's like, okay, let's talk about this. Nothing wrong with a manufactured home, but typically there's more cost, right? It's perceived as more risky, so the cost for the rate is a little bit more. Then, more than likely, we're gonna need a structural inspection, right? So we're gonna have a structural engineer go out there. It's gonna be $450. You know, we don't know whether, you know, hopefully it's been properly detitled, right? So, you know, with a manufactured home, if it ever had wheels under it, it's considered a manufactured home. Even if it's a Frankenstein home where they built onto it and they added, you couldn't tell that it was, if somebody calls in there and sees beams under that thing, it's like, man, this thing was a manufactured home, right? It is. There's no getting around it. So I've seen that before, where it doesn't say anything, but for some reason, somebody looks and says, oh, those are beams from you know, the wheels weren't there, but the axles were still there. And they see it, but the house is all, you know, 2 before construction, you know, sheetrock walls, but nope. you know, it's got some DNA in there that was manufactured, so, but it has to be properly detitled. Sometimes it's been done correctly, sometimes it hasn't. Those are some things from a listing standpoint. If you're gonna list any manufactured homes, man, if you can try to find out what really is going on with that thing, you know, talk to a title company, see if you can get, you know, has it been done properly? Because we could get tied up in something that, you know, if you know, we care that it's been, you know, the title has been removed and now the house is part of the land. So, you know, when you buy a land home package, many times what'll happen, we'll see this with Vanderbilt, I think they wanna keep the house and the land separate, because they could pull that house off. You know, if they're separate, you know, because it still has a title on it, they can remove it, but they need to be, you know, we don't want anything that anybody can hook to and drag off. Really, so if it hasn't been properly detitled, then sometimes they'll do it before closing, sometimes they don't wanna do it until after closing. You know, it can be a challenge, and it could be time consuming. And, you know, if you can't find the proper markings inside the manufactured home, you know, how do you prove when it was built? You know, you can go to Nashville and get the title, but you gotta have at least some information about it. What's the serial number? So it can be a challenge. Yeah, tricky. So, what do you think? Any other? How's my time? We're still waiting on, I gotta keep you entertained until the food gets here. So, it's not gonna be pretty if we have to start doing that. So, you had a really good question, that, of course, he had a question. So it's like, how can you be pre-qualified and then not pre-qualified, right? That was one of your questions. Like, how come somebody you gave me a letter and now they're not pre-qualified? And so, well, we don't really like for that to happen. The thing that I see most of the time is just the loan officer is just, didn't take the time to dig in and get all the details. Right? Oh, looks good, sounds good, you know, turn you loose, we'll figure out later. Really don't like to do that. And so for me, what I do is I say, well, there's pre-qualification and there's pre-approval. So pre-qualification means that I pulled your credit and everything you've told me sounds all right, right? How many hours a week are you guaranteed? So how many hours do you get? It's always 40, right? But how many are you guaranteed? Well, I think it's 32, 30. Okay, well, it's kind of important. So I've got to make sure that I get the integrity of the data is the big thing. So the answer usually becomes apparent once you get enough questions answered. So what I will do is I'll start off with a pre-qualification, which means everything you've told me sounds good. I pulled your credit, why not? But then I need to get your documentation just as soon as possible. So what does that look like? I need to get your bank statements. I need your pay stubs. I need, and if it's complicated, which a lot of people are complicated these days, and it's like, well, I had 4 jobs in the last year, and I had a gap, and oh goodness. So, I tell people, it's like, I can't, send me a resume, right? Show me start and stop dates. Or, I had a young fellow the other day, I said, get with your mother and have her get her calendar out and say, well, this is when I stopped on that convenience store, and this is when I started on this other job, because it's so important. I can't be kind of sorta, right? So what we're trying to do before we turn this young man loose, he's frustrated because we're not turning him loose. He wants to buy a house, and I'm like, you're gonna start spending money on something that you're gonna be wasting your time, or everybody's time. So we're trying to make sure that we've got it. So we're getting him to fill out a form that allows us to go to his previous employers, and so we can get a verification of employment. He's worked at a place in Gatlinburg, he worked at a convenience store, he's this, he's that. And so if the dates don't line up, then if the gap is too long, it's no. If the gaps are okay, then it's yes. But it's right on the edge. So he's frustrated. Can I buy this place? Can I buy this place? It's going to get away from me. I'm like, okay, first of all, don't try to get under contract and then come to get qualified. Please don't do that. But so we're trying to figure out, what's really going on. So we're sending verification of employment forms to his previous employers. They're filling them out for us. They didn't fill it out right. you gotta go back to them. So those are the things you don't see on our side, that we're trying to make sure that we don't turn them loose. And I'm convinced that a lot of loan originators just say, no, right? It's easy to say no. There's really no risk in saying no. You don't make any money when you say no, but, So, but that's the reason we run into issues where somebody is qualified and then not qualified usually, is because they told us they make so much an hour. I've had people say, well, I work for so-and-so, and then the pay stub comes back, it's a completely different company. Oh, you didn't tell me it was a tin company, you've only been there for. So that's the reason that, or it could be that we just didn't do the proper due diligence, whoever the loan officer was, they bought a car, their credit score went down, all kinds of things like that. So anyway.
Can you eliminate appraisers? I know you can't pick them, but can you not even put one in there?
We tried really hard, like you, out of the gene pool, right? So we've asked, there's certain ones that we can, right now there's so much business and so few, there's not enough people to do the business. We're many times stuck with what's out there, whoever picks it up. But the idea of having that first pool of the people that we can pick to put in there, and then the problem is if they don't pick, then they keep going out to try to avoid it. But there are ones that we don't really care for. But it's more difficult now than it used to be to have somebody out of it, because it's the ones that we want in there are.
If your client specifically asks for one.
If they asked for one to be that appraiser or to not be on there. We have to take that on a case-by-case basis, but if we knew that, we could, so what happens is, we order it, we don't know who picks it up. You would know, typically as a listing agent, before we would know. Because so-and-so's gonna call and say, I need to set up a time. At that point, if you call us and say that we can't, this person is, they're compromised, or we don't like them, or whatever it would happen to be. I've never had anybody taken off, but I would think there's a process to have that, to do that, right? If there's a history to it, if there's a conflict of interest or something that we'd have to, or you could just say, don't, you can't come. I mean, you don't have to let somebody on your property. So, I don't really know. I'm sure that we could work something out, but it would have to be definitely on an exception basis. So.
One more.
Okay, oh yeah,
Barn dominions, are you familiar with those?
barn dominions. I think I know what the term means. Tell me what the term means, so I'm on the same
The
page.
most popular thing in Tennessee.
Imagine Lincoln Walters as a house.
It's okay, it's
Basically,
like
it's
something that was
residential
a-
post-steel construction.
You took it, okay,
AKA.
post-steel construction.
Residential post-steel,
No, I think you just have to have comps. I mean, I really think that's what it ends up being. I
That
mean,
would be tricky, wouldn't it, though?
yeah, I mean,
I mean,
yeah.
I haven't seen any comps for them yet.
There's one in Blountville that's
Yeah,
super nice.
yeah, yeah. That's a, until we run into, there was a time, 6, 7, 8 years ago that we, I don't know the whys behind it, but there was a time when if somebody had a metal roof on their house, it was different enough that we needed to have comps of houses with metal roofs, which I thought was crazy at the time. But you haven't seen that in a long time, so either they're more prevalent or it's not an issue. So, I don't know. Great, 2 things, and I'm over 2 here.
Thank you so much. I don't think it was great.
Well, we'll make sure that he brings home some burn ends, and if if they don't make it home, you let me know. We'll have some delivered, or Chick-fil-A lunch.
There you go.
Bye.
Bye.
Bye. So, I have a question for you all. So what do you think, what does 2021 look like? Lincoln, what do you think?
Better than 2020, I hope.
What we hope.
Hopefully not locked up, locked down.
Yeah. I mean, seriously, like, I'm looking at this thing from.
In what aspects, what capacity?
Well, I mean, how do you think it's gonna affect real estate? I mean, really, as it relates to real estate in our market?
I think it could vary greatly depending on what happens tonight.
Today,
Yeah, true, I agree.
Scurry.
Yeah.
I don't even know, because we have a lot of people coming out of here because of whatever's going on with the climate in bigger cities.
Mhm.
You have people realize that if they're in a bigger city, they're around a lot more people, that increases their chance to get sick, so like, I need to get out to whatever, right, kind of stretch out. I had a lot of people that were able to work remotely, and so they're able to stretch out again. This is becoming, ever since it hit one of the best, was it top 5 or top 10 places to live or something, Johnson City, top 5 in Tennessee or something?
Mhm.
And so I've had people say, yeah, we've heard about you that way.
Right.
So I think we're growing that way. We're still at an inventory deficit. More and more people are.
I was gonna ask about that too, yeah.
Money is still cheap to borrow. We got stuff coming to the area that are continually bringing jobs. So
Yeah.
I'm hopeful.
Yeah.
And I think whatever happens, there'll be a lull, and I think it'll go right back to what it was
Yeah.
for a minute.
Yeah, interesting.
I think this area will be the last to fall,
Yeah.
just
Yeah.
my opinion.
I think
Yeah.
so. I think we hear about stuff in California, because California is still off the rails. Everything's moving super quick in the midst of everything. They're still breaking records and doing a lot of fun stuff. And same thing in Atlanta. People are still moving in, so I think we'll feel the tremors a lot heavy in advance before it actually
Yeah.
shakes anything.
There's a Mortgage Bankers Association headline says forecast record purchase origination volume in 2021. So they're expecting across the nation 8.5% increase in purchase originations, which means purchase business.
Yeah.
And so we expect our expectation is that refinances are going to go down just because rates will probably go up, but more than anything that everybody that could refinance is probably refinance by the time we get to first quarter of 2021. So and then there's another headline from I don't know what this is, Fox Business. Millions of Americans plan to move to more affordable areas amid pandemic. This is recent. It's like and I think it was Jessica Cook. I think she mentioned anecdotally at our drive-in movie. She said like half the people that she's doing are moving across town, and the other half are moving in from out of town.
Yeah.
And so I've been thinking, we're in the midst of getting ready to do some strategic planning. So we'll bring you some, so we'll bring you some burnouts. Okay, well, I'll put a box and have your name on it. Okay.
Bye, Megan.
Fine. But thinking about next year, so I'm thinking, well, what are some opportunities? Like SWOT analysis: strengths, weaknesses, opportunities, and threats. So what are the opportunities for us? Well, people moving in from out of town. So for you all, I would be thinking that you're thinking, you're already doing virtual showings, right? Showing people around, take your iPad around, and then you've also. But I'm thinking, do we need to do more video? For these people who are moving from California or wherever, then, do we push that? Make that more of what we do, or make all of our stuff virtual easier for everybody. So, do you see any new construction? I mean,
Yeah.
there's some stuff coming, but the building materials are crazy expensive.
Yeah.
Getting tradespeople,
It's near impossible.
yeah. What do you think, Mr. Builder?
Bob the Builder. Think about new construction? What do you-
Yeah, I mean, I'm just,
Coming in with tail.
the whole inventory thing right now, right? So, I mean, there's
Oh, the lack of inventory thing?
lack of inventory, and I mean, it's driving prices up, and it's driving,
Driving me crazy.
yeah. Yes. I mean, we thought about, my wife and I were like, well, we could, this house is worth this, we could move up, there's nothing to move up to.
Yeah.
There's nothing that's interesting,
I've seen a lot of new construction pop up. I mean, that's the thing that has to give. People come here, they're like, oh, paneling. And then I'm like, all right, you just spend $100,000 more. They're like, all right. And they're like, okay. And then that market starts going up.
Yeah.
And then the new construction is popping up. And then
Yeah.
you have your forms with that, but there's nothing there. And so when people want to come here, in Nashville, they're developing little neighborhoods that are just specific to Californians. They
Really?
look like California little houses because so many people are leaving and coming over there.
Right.
So Nashville's exploding.
Right.
And as Nashville explodes, people are spreading, and then
Right.
Knoxville, I feel like will start to bleed over, and then I think
Yeah.
it'll get to here as well. So I definitely think
Little
property
more
values
Tennessee.
need to go up. Property values go up, new construction has to give, because everything here is people, they're like, this house was built in the 40s, incredible. Like, you know, it's like, yeah, wow. And they're like, I haven't seen anything past 2000, you know, so.
Yeah.
I think that's got to give there as well. But you're absolutely right with the labor. I just talked to a builder that is new to the area and was like, I thought it was gonna be a lot cheaper to build here, but as soon as we got involved, lumber was up, everything was up.
Yeah.
And so,
Yeah.
I just think people will keep paying as long as the money's cheap.
Sorry, man.
We go to Virginia
It's all,
City.
it's all Misty's fault.
No worries. I had emailed you, or not emailed you, I emailed the office a couple questions that I've gotten lately about VA stuff,
Okay.
specifically funding fees.
Yeah, I sent that to Misty. Did you get that, Tim?
What's that?
I sent that to Misty. Did you get that
I
too?
haven't seen it yet. but-
Okay.
Funding fees? Is it
Funding fees and closing costs, how much can they ask for,
Okay,
stuff like that, but just simple VA stuff.
okay, all right, cool. All right, there'll be leftovers, I promise.
Oh, I know, buddy. I'll get some this evening. See you guys.
Ah.
See you, man. So, I can't dance, and I'm not.
But
really
can you
good at singing.
sing?
I know, I can't. I'm really not good for much of anything. man.
All right, well, thank you, Tim. That was very thorough. We
Well, good.
appreciate you.
Thanks for having me.
Thank